All right, so can you please confirm if my screen is visible and my audio is clear?
It's clear.
Perfect. So this evening, we are going to look at IAS 36, impairment of assets. It is a very important standard when it comes to your paper. And trust me, you will not miss it in section A. Trust me. Therefore, you should give it maximum attention. As it has been our culture, before we start on a standard and what is important, then we go ahead to answer some questions. I have always given you the basics that we should always know very well in a given standard. Let me hope you are all noting them down. When it comes to IAS 36, you must, of course, know the definition of impairment. Otherwise, how will you attempt it? So, definition of impairment. As someone prepares to give me that definition. Next, you must know the indicators of impairment. Please prepare. Then you should know, this is the easiest, calculation of impairment loss. Of course, if you know the definition, then this becomes very easy. Then how do we recognize? Recognition of impairment loss in the financial statements. Then you must know amortization. You must also know cash generating units, what we call the CGUs. Very important. And you should also know, okay, so for cash generating units, what must you know? I think, let me do this. Let me do that. So under CGUs, what do we need to know? We need to know the definition of a CGU. Then we need to know allocation of assets to a CGU. Then we must know allocation of impairment. I'll call it impairment loss to the assets in a CGU. Then we must know the reversal of impairment loss. Notice number 7. Reversal of impairment loss. And then we must know the disclosures. Disclosures required. So this standard seems to be lengthy, but trust me, when it comes to your papers, it is easy because you can easily see the points given in the case scenario. So these are the basic 8 things that a student should know under IAS 36, impairment of assets. Remember, this is a revision session. I therefore buy an idea of you people giving me the answers so that we can just be interacting. Then my support comes in when we are handling a question on the standard. Perfect. So, since it is revision, can someone give us the definition of impairment? Yeah, is someone putting up their hand or someone's just... Oh, yes, Raymond.
Impairment is when the recoverable amount is less than the carrying amount of an asset.
Okay. When the
Recoverable amount is less than the carrying amount of an asset.
perfect. Well said. The question is going to come in, what is recoverable amount? We shall see that when it comes to calculation of impairment. Okay, so in your exam, you will say, as per IAS 36 or in accordance with IAS 36, impairment is a reduction in the recoverable amount of an asset or a CGU below its carrying amount. Should I repeat that? I know you'd have your notes because you've watched the classes, so no need of writing this again. I can just maybe give you the key points. Can you please hear me? My network is not okay. We've talked about, can you please hear me?
Yes, we can hear you.
All right. We've talked about reduction in recoverable amount below the what? Below the carrying amount of an asset, of course, of an asset or a CGU, a cash generating unit. However, in the exam, if for you can remember that impairment is or impairment occurs when the carrying amount of an asset is above the recoverable amount, you also get the mark. Secondly, amongst the basics to know, we've talked about indicators of impairment. How do we know that the carrying amount of an asset is above the recoverable amount? There are two indicators. The first one being external indicators, then the second one being internal indicators. So I'll ask you, what are the external indicators that the carrying amount of an asset is above the recoverable amount? External indicators. Then we have the internal indicators. So from your classes, what are the external indicators of impairment? Let me give an example. Joseph, can you hear me? Okay, let me go to Raymond. Raymond, can you hear me?
Yes, I can.
Okay, maybe Joseph has network issues. Okay, Joseph, no issues. Raymond, you have an iPhone. Don't tell me you don't have it, but I'm just assuming. These are case scenarios. You have an iPhone. How can you know that its carrying amount is way above its recoverable value?
You are not audible. I'm not getting you.
Yes. Can you hear me now?
Now I can hear you.
You have an iPhone.
Yes.
How do you think you can know that its carrying amount, what you think it is worth, is way above its recoverable amount?
When the market value is below my carrying amount,
When the market value
is below my carrying amount,
is below
the carrying amount of the iPhone.
Perfect. So you've told us that any decrease in the
Market value.
market value of the asset. So if the market value, in fact, this should be sudden, right? Because before you think you owe an iPhone, it should be at a given value. So any sudden decrease in the market value of that asset can show you that, trust me, your iPhone has undergone impairment. Which other indicator do you think can show you?
When it's not doing what it's supposed to do, let's say for production, let's say for pics, it's not taking the right quality of pics it's supposed to take. So a reduction in its output.
Is that external or now that is internal?
That is the internal.
That is internal then. So I can put it here.
But,
Perfect. That is internal.
But then I also thought this one of any decrease in the market value. So that I thought that is internal.
No, market value. Where do you get the market value from?
From the outside.
You get?
Yes.
So, but now the one that we've talked about, the decrease in the performance. The decrease in the performance of the asset. That should be the decrease in the expected performance of the asset. That is internal, because you are using it and it cannot give you what it is supposed to give you. So that becomes an internal indicator. Thank you so much, Raymond, for the discussion given. Yes, Michael. Michael, unmute yourself. Unmute yourself.
Okay, sir. Now, okay, in case of Resmond phone, what about the technology? Is technology external or internal? Because the phones goes along with the technological aspect. Because each time there's a new iPhone, so it will become outdated.
That is a
So
very...
it is not an...
Michael, can you hear me?
Yes.
That is a very good point. Any sudden change in the technology can affect the value of the iPhone. That's why you see that whenever there is a new version of iPhone, the previous ones, the value does what? The value fall. So that is a very good point from Michael. We can say any sudden change in technology can be an indicator of what? Of impairment. But remember, those who did economics, you know there are other factors that can change with change in technology. Okay? We can talk about the economic or legal environment. So any change in technology or economic and legal environments. But now when it comes to Raymond's iPhone, any change in technology can be an indicator of impairment. Is that okay? I'm going to ask you, remember we are talking about, we defined impairment as a reduction in recoverable amount below the carrying amount of an asset. Let me give you a hint. With this definition here, you can also get some other factors. And how can you get them? How do we obtain recoverable amount? Can someone tell me? Okay, someone's hand is up. Yes, Joseph.
Yes, you can hear me?
Yes, we can hear you.
Yeah, recoverable amount would be the higher of value in use.
Perfect.
Or fair value, less cost to sell. The higher of the two.
Perfect. You've said recoverable amount is the higher of value in use or fair value. Joseph, out of those answers given down, which one covers higher value? I mean fair value.
Fair value is the second one.
The second
Fair
one,
value less cost to sell.
I mean,
Yes.
you've given me the definition of recoverable amount, okay?
Yes.
So we want a trick of identifying which factors can show impairment, right? From that definition.
Sure.
So out of those points we've put down, which one talks about fair value?
I think I can formulate one in regard to maybe increase in cost of sale, because that one would ideally lower down my final recoverable amount if the cost to sell increase
What does this
unexpectedly.
What does this imply?
Decrease in market value.
Yes, that's already a fair value, right? Where we said
True.
fair value is that price you obtain from a transaction between market participants. So,
Oh yeah, true.
in the definition of recoverable amount, we've already picked a point: any decrease in market value of the asset. Now, which one is remaining?
One in fair value in use.
Value in use. How do we get value in use?
Discount, we get a present value of the future cash flows of the asset.
Perfect. Now, when you're getting the present value, which factor inside there is affected by the market conditions?
The discount rate?
Perfect. What we call the interest rate. Are we getting it?
Yes.
So that's how I have derived you until when you got me the answer. Eh? So any increase in the interest rates, okay, which of course an increase in interest rate, what does it mean? It reduces the asset's what? Value in use. I don't know if you're getting it. Which reduces the asset's value in what? In use. And of course, once value in use reduces, what happens? We take an impact on recoverable amount. Is the team getting the point? Okay. So we have listed 3 factors, and I'm sure you've read many. Let me take you back to at least let us also raise some under internal factors. Is Florence here? Florence, can you hear me?
Yeah, I can.
Florence, you own I will use this a sewing machine. Okay. Then
Yes.
you own a sewing machine, then you have this baby who jumps everywhere, and you return home when it is damaged. Do you think in your books that sewing machine is at a higher value compared to what you can receive when you sell it?
I think it's not, because it's damaged.
It means since it is damaged, yeah?
Yeah.
When you take it to the market, can you get the same amount as you recorded in your financials?
No, you get a lesser amount.
Meaning that the carrying amount at that point becomes higher than the recoverable amount. So any sign of damage to an asset, is an internal indicator of impairment. Did you get my point, Florence?
Yeah, I got it.
Any damage to an asset is an indicator of what? Impairment. Now, in your case scenarios, they will not give you these simple things. They will say that this company is in forestry. Then a fire caught up one of its plantations. At that point, just know that they're talking about what? Impairment. Because there was damage on some of the assets of the company. Or they will tell you this is a human air manufacturing company. It suffers with floods. On this date, floods destroyed part of its warehouse. At that point, since there is damage of the asset, then that is an indicator of impairment. Yes, Raymond.
So for that case, also when you via reporting whatever events after the reporting period, also that happens. So how do you differentiate that this is for impairment and this one is for events after the reporting period?
At the end of the course, I'm going to show you some standards that move hand in hand. You get it? IAS 36, IFRS 5, IAS 10. Okay? In fact, even IAS 8, they sometimes move hand in hand. Where you talk about impairment, you are likely to talk about events after reporting period, depending on how they phrase the question and the scenario. Do you get it?
Yes, I get it.
We shall have a question, and I think I have a summary of those standards that move hand in hand. That if you talk about this standard, you cannot miss out this one. And trust me, it works out. Okay. Since this is revision, let me ask who is here? Who is here and is very quiet? I think you are all talking. Okay, Joseph, how do you calculate impairment loss? Anyone who can answer? How is impairment loss obtained?
Yes, hello, Ivan. Can you hear me?
Yes, we can hear you. Hello, we can hear you. Putting up their hand. We can hear you. Okay. Who can answer the question? How do we get impairment loss?
I think when we get to the recoverable amount, we take the higher of the value in use and the fair value less cost to sell.
Yes.
Then
You're
we
saying,
get the
wait. Recoverable.
When it comes to
recoverable amount equals higher of fair value less cost to sell and value in use.
Then after getting the higher of the two, we go to the lower of the carrying amount and one of the two that we have gotten the higher. Then after we get that amount less the carrying amount.
So
I feel like that's how we get the impairment loss.
Okay. So meaning that we said at the point where the recoverable amount is below the carrying amount, right? So if we get our recoverable amount and we less the carrying amount, not so? But since the word loss is already negative, we are going to say carrying amount minus recoverable amount. Is that okay? carrying amount minus the recoverable amount, but recoverable amount is that. Is that okay with everyone? Is that okay with everyone?
Yes, it is.
Of course, we shall not do so much of calculations with your level. How do we recognize impairment loss? Where do we take impairment loss? Yes. Is it in the profit or loss, or in the statement of is it in profit or loss, or in the statement of financial position? Wanji,
Profit or loss.
it starts with a statement of profit or loss. These are points that you're going to make while making your case in your answer. So once we receive impairment loss, it is charged to the statement of profit or loss. However, there is a point. Which point is that? Under what conditions can we take impairment to other comprehensive income? Yes, someone's hand is up. Yes, Florence.
In case there is a revaluation surplus, you take the impairment loss and you reduce. So the balance is taken to the profit or loss after reducing the valuation surplus.
Very good. Note, if an impaired asset had been previously revaluated and revaluation surplus taken to OCI, then the impairment loss for the year is charged to OCI, and any remainder taken to profit or loss. Remember, we said we are discussing only the basics, and so that one you should be knowing at least, because we've discussed this still even under IAS 16. Is that okay with everyone? Okay. This one here, of course, after charging impairment, because remember, we are comparing carrying amount and recoverable amount. When there is impairment, then the asset is taken to the lower of carrying amount and recoverable amount. And at that point, it is going to be the recoverable amount. At that point in time, we must amortize or depreciate the asset over the remaining useful life. So I'm going to say upon getting the impairment loss, the asset is treated at the lower of carrying amount and recoverable amount. And in this case, it is always the recoverable amount. That is why there was impairment. And the asset is depreciated or amortized it is depreciated or amortized using its remaining useful life. Is that okay with everyone? Any question regarding that concept? I'm sure you're all saying these are all basics because you've been revising them. Okay, since they're all basics, can we go to CGU? What is a CGU? What is a CGU? Guys, this is a revision. Michael, are you speaking? We can't hear you. Yes, Joseph. Michael, yes. Unmute, okay.
Yeah, a CGU is just a group of assets that generates cash flows separately.
Perfect. It is a group of assets that generates cash flows separately. As simple as that. As simple as that. I'll ask you, Manchester United. I'm a fan of Manchester United, even though we are still struggling. Manchester United has restaurants, what we call cafeteria. It has a team, players, right? Please take note. We have a cafeteria where fans buy drinks, food and all, snacks. We have a team of players, the first 11. Then we have, let me say, we have Onana. Out of the 3, which ones are a CGU? Yes?
Repeat again.
We have a cafeteria, a canteen. We have the first 11 team, first 11, the players. Then we have Onana as an individual. Out of the 3, which ones are a CGU?
All of them.
Even Onana?
Yeah, one is a goalkeeper. And the whole. Okay.
You see, a canteen is the smallest group of assets. They have the refrigerators, they have the microwaves, they have whatever. So that one can generate its own separate cash flows, right? Then the first 11 is a group of assets because players are assets. Those who have done enough questions, you will find that you found a question where a player's contract can be termed as an intangible asset. So, the first 11 is a group of assets. And therefore, when we sell their shirts, when we win games, they generate independent cash flows. However, Onana as an individual cannot be a CGU. Does that make sense to everyone?
It doesn't, because I also thought Onana would be an asset, because we consider an asset to be something, and we consider an asset to something that an item that brings in economic benefit. And bringing in economic benefit, we must be able to direct its use and then obtain all the benefits. And I feel like we can choose either to put Onana in the goalkeeper position, or put someone else, or put a substitute.
Yes. Yes.
And I also still feel that when Onana is when he's via the like via the pitch, people are watching him, and yeah, there are people that like him, and because of Onana. And actually, even if we sell his shirts, we still get money. So I'm doubting how Onana is not an asset in this case.
Don't put me wrong. I said as per IS 38, Onana is an asset. Do you get me? And even the definition of an asset as per the conceptual framework. However, Onana is not a CGU. If we want to evaluate the performance of Onana, can we say that Manu is performing well because Onana is performing well? Is it possible?
No.
So, Onana as an individual player is not a CGU, but the team of 11 players is a CGU. Do you now get the difference?
Yeah, I now get the difference.
Perfect. That was my point. Yes, Michael?
They're not very well.
Yeah, Ivan, why don't we put it in simple terms? Yeah, that Onana does not suit the definition of a CGU because Onana is a single individual and a CGU is a group of assets.
You can also
So
take
this
that
disqualifies, this disqualifies Onana to be a CGU.
Okay.
And it qualifies the 11 players in the pitch to be the CGU because they are separately playing.
Perfect.
And the achievement is just only one.
That is well said,
Thank
Michael.
you.
Yes, Florence.
Ivan, instead of using the football thing, because some of us are confused,
Yes.
you could just maybe use subsidiaries and we get what you're trying to mean.
Subsidiaries. Okay. Let me use that example. Okay. I'll give you Coca-Cola. Florence, Coca-Cola has a branch in Mbarara. Are you aware of that? In the West?
Yeah.
Coca-Cola has head office in Namanvi, right? So,
Yes.
if this head office is used by the Mbarara branch, let me say that they have a building in Namanve. Human resource resides here in Namanve, finance, audit, but these people also serve the team in Mbarara. Can we treat this head office as a CGU? Can we? No. So, since this head office serves other offices in the country, cannot qualify to be a CGU. I'll give you another basic example. You have my friend owns a lodging. Okay, we can say a bar and restaurant. You get it? This bar and restaurant, at the side of the restaurant, we have cooking stoves, we have microwaves, we have serving tables, we have sets of televisions. Okay? Then at the side of the bar, we have refrigerators, we have drinks, we have also sets of televisions. when we combine the television sets, the refrigerator, the bottle of sodas and beer in the bar, that makes it a group of assets that generate independent cash flows. Therefore, that bar is a CGU. Just like even the restaurant is also a CGU. But we can't say that the refrigerator alone is a CGU. Does that now make sense to you?
Yeah.
All right. So that is as simple as that. In the case scenario, it will be very clear, as we shall see, so that you can easily identify if that is a CGU or not a CGU. And the allocation of assets to a CGU, my point of interest or my point of discussion was 1. Okay, we can only include an asset to be part of a CGU if it has an ability, okay, to generate cash flows, okay, that can be used in the value of the CGU. Does that make sense? Only include, we can say only include carrying amount of assets in a CGU if that asset has the ability to generate cash flows that can contribute, okay, that can contribute to the value of the CGU. Meaning that if you have an asset but it has no ability to generate cash flows, then you cannot include its value when we are valuing the total value of the CGU. Are you getting it? Any question regarding this, or I proceed? I'm sure this is revision. We should be having these concepts. Any question, or I proceed?
Hello?
Yes, please.
Evan?
Yes, please.
Yes, my network has been breaking. I've been hearing partly what you've been saying. But I can maybe just ask one thing. The network has been breaking, but I can maybe ask one thing. Yeah, to contribute to a CGU, it should be able to generate. Even now?
Yes.
What about now?
We can hear you now.
Now is okay? Okay, so I was saying I would understand that for an asset to be part of a CGU, it should be able to generate separate cash flows. So if it's unable to generate independent cash flows, then it wouldn't be part of a CGU. And then you're trying to give that example of a football team that Onana as a goalkeeper, since he can't generate individual cash flows, he can be part of a CGU of the entire team, but the 11 players can. Yeah, so I was wondering for the individual players, I wouldn't also think that for one player can generate a revenue or something, because it is a team. They have to play all of them to actually generate cash flows. So that means that an individual player also can be part of a CGU, since him individually can't raise cash flows because they can't play alone.
Yes, if you see, an individual player has to be can be part of what? Can be part of a CGU, because individually, when we consider individual performance of the team, they have a contribution. You get? But we can't say that an individual player is a CGU, but a group of players becomes a CGU. I don't know if you're getting the point.
Yes, I do.
Okay.
Ivan,
Yes, Florence.
but then why does the definition say that it's the smallest group of an asset that generates independent cash flows? The smallest group.
Uh-huh. You see?
Yeah, so why?
Hmm.
Yeah, that's what I'm asking.
I gave you an example of a restaurant and a bar. Okay? With a restaurant, you have a refrigerator, you have microwaves. Those are smallest group. Those are group of assets, right? Which when combined can give you a meal that you sell. So they can generate separate cash flows. Is that right, Florence?
Yeah.
Then when it goes to the bar, you also have different assets that when combined, someone comes and takes a bottle of soda. You also generate cash flows.
Okay.
Does it now make sense to you?
So meaning the restaurant is a CGU and also the bar is a CGU.
Yes. Can't you generate separate cash flows from the two?
You can.
Because you can say I will have a restaurant alone, or I'll have a bar alone.
Okay.
Now my question is coming to what is the order of allocating impairment loss in a CGU? Yes?
You first of all, okay, you first of all attack the intangible assets.
You take two?
You attack. That's what I mean.
You
You
attack.
charge.
Mm.
You charge the first part of the impairment
Mhm.
to the intangible assets, such as goodwill and maybe some others.
In fact, the standard tells us that we first take to goodwill. Okay, it says one, first charge those that have already showed impairment. Are we getting it?
Yes.
If in the question they have told you that there is an asset that already has showed indicators of impairment, so impairment loss first goes to those ones. Then secondly, you look at goodwill. Then thirdly, you prorate the remaining one. Okay? First impairment loss is charged to all assets that have indicators, okay, that have experienced impairment. Then secondly, we say that charge to goodwill. Then thirdly, we prorate. Okay? Prorate the remaining impairment loss to other assets in the proportion of their carrying amounts. Is that clear with everyone? Is that okay? So that's what the standard tells us. Let us proceed. I want us to finish up the standards under these non-current assets. Assuming that, I think we've been discussing this over and over again. Assuming that last year, okay, assuming that last year an asset showed impairment, okay, had indicators of impairment, right? We calculated and recognized an impairment loss. Then this year, we review that asset for impairment. Remember, the standard says we must annually or at each reporting date review an already impaired asset so that we can ascertain if there are changes in the same. Maybe I should write for you that it is required that an impaired asset is annually or at each reporting date reviewed for impairment. To assess if the conditions that caused impairment reversed. Now, if at one point you realize that, okay, I had charged impairment loss to profit or loss, now this impairment has been reversed and this asset is showing that the recoverable amount is above the carrying amount, then the impairment loss that was recognized earlier on has to be charged as income in the profit or loss. Is that clear with everyone?
Please pardon on that.
Let me type it. If an impairment loss had been charged to profit or loss in the previous year, and then at the next reporting date, it is observed that the conditions that caused impairment reversed. As such, the carrying amount is below the recoverable amount, then the initially recognized impairment loss should be charged to profit or loss as income. Does that make sense?
We cannot see what you are writing.
You can't see what I'm writing? Oh, my network, sorry.
Yes.
My network is off, but give me a second. It should be back. It is back now. Can you see it?
Yes, it is.
Yeah, welcome to Uganda Network. So, that's what I've been saying, and you can go through it to see. Yes, please. Oish. Yes, let us wait for Joseph. I think he's yet to join in. Joseph and who? I think it is Joseph. Let me check. Okay, Joseph is here. Yes, so can you please confirm if my audio is clear and my screen is visible?
Yes, you are.
All right.
It is clear.
Okay. So we are discussing about reversal of impairment loss. I told you, please note, this is a basic that you should know, that if you initially, or if there was an asset that had been impaired, then at each reporting date, you must review it for impairment. And if there is any case that the conditions that led to impairment were reversed, and therefore the asset is no longer impaired, then the previous recognized impairment loss should be charged or should be taken to profit or loss. Let me not use the word charged. Should be, okay, where is it? Not this one. Should be taken to profit or loss as income. Is that clear with everyone? Okay, someone wants to... Yes, Michael. Michael, unmute yourself.
Yes, sir. Ivan.
Yes, please.
Yeah, I'm saying I would want to ask a question on this, not to redefine the standard, but to seek some clarification on this.
Yes, please.
Now, in the previous year, okay, you charge the impairment loss to a profit or loss.
Mm,
Now, this year, the conditions that caused the impairment have reversed.
mm.
So, other than okay, taking it back the profit or loss of the current year, why don't we just put it directly to the retained earning?
Why don't we just charge it to retained earnings?
Yes. Other than putting it to charging it to profit or loss for the current year, yet it was for the previous year.
Mm.
Yeah, that doesn't make sense.
That is a good one, but see, we are all aware that the previous year profits were already reported to what? Were already reported to retained earnings, not so? That's why you're saying that why don't we take this income now to retain the earnings? That is a good question. Anyone who can answer before I give my submission?
I think we cannot take it to the retained earnings because it has initially been charged in the profit. It has initially been put in the profit or loss.
Mm-hmm.
And if it was charged, for example, in the OCI, let's say for the first time when the whatever the impairment loss occurred, and it was put to the OCI,
Mm,
then when the reversal comes in,
mm.
I feel like we go back to the OCI and we put it back. Then we credit to the revaluation reserve. I feel like that's it.
And it has answered. If, okay, remember, where is the retained earnings located? It is the statement of what? Statement of
Statement of financial position.
changes in equity, right?
Yeah.
Okay.
In the statement of financial position is.
All right, I get your point. But here, the argument is, if the impairment loss had been taken to an earlier on revalued asset, meaning that if it had impacted the OCI, then when we are reversing, we take it to OCI and we put it under revaluation reserve. If the impairment loss was taken to profit or loss, it must go to profit or loss as income. Just as you said, you are not against the standard, you are trying to be inquisitive. You get it?
Yes, sir. Now, my point is,
Yes.
yeah, actually, I had some concept on this that I would want to make it clear. You see, the statement of profit or loss, what was affected by the impairment loss
Yes.
was the one from the previous year.
True.
Now we want to reverse the affected profits,
Yes.
okay, of the last year, the previous year. Then, can't we take this portion? Because each year we transfer, okay, the profit to retain earnings each year, okay?
Yes.
Instead of putting it back in the profit or loss, can't we just go take it directly? Does the standard allows that?
Now, Michael,
Yes.
do you know the difference between IFRS and GAAP? Do you know the difference?
Yeah.
What is the difference?
Okay, standards are specific, while gaps are general.
Now you're reversing it. With IFRS, we are principle based.
Okay.
That so long as for you interpret a condition and you think representation of the financials, you are right to go. IFRSs are not strict. They are not strict. But GAAP for the UK, no, for the US, for them, if there is no standard that covers something, they must develop one, because they are rules based. So, with your interpretation of why don't we take this part to retain the earnings, because we transfer the profits to retain the earnings in the running year. You are right. We are running principle based accounting. So long as you feel it gives fair representation or faithful representation, then you are good to go. And that is the level of reasoning that you must bring in the exam, not what you crammed in the notes. Is that okay?
Thank you.
Right. Let me hope you guys know that we can only test for impairment if there are indicators of impairment. Is that true? Are we all aware of that? We can only test for impairment if there are indicators of impairment. My question is, which asset must be tested for impairment every year or at each reporting date?
Assets with indefinite useful life.
Perfect. Another one?
Goodwill.
Goodwill. I hope we all remember that. Assets with indefinite useful life, because for them we do not amortize them. So we should review them for impairment annually. Then secondly, goodwill should be reviewed for impairment annually. Another thing that you should note, under reverse of impairment loss, any impairment loss charged to goodwill cannot be reversed. These are all basics to know. Any impairment loss that has been charged to goodwill cannot be reversed. Is that okay? We go to a question now. Disclosures, as I said, please go ahead and read about them. Examples or example. Okay, let me check for an example here that we can try out. Meanwhile, we are now diving into the serious standards, and I'm sure you guys are building the confidence in answering what? In answering questions. Okay, I'm looking for a question that we can try out. Impairment, where are you? Okay. And we've been talking about football player. The one that I'm getting for you is about football players. So Florence, you don't have to say that for you don't know football. In the exam, the guy will bring anything they feel practical, so that you fight with it. Okay, is someone trying to ask a question? Yes, please. Was someone trying to?
Yeah. Mr. Ivan.
Yes, please.
Yeah, before we could go to the example above, actually, I would want to take you a little bit back
Yes, please.
for the reversal. Now that we adjust the profit or loss, now what do we do to the individual assets?
What do we do to?
Yeah, the individual assets. Yeah, the reversal has occurred. Yeah, what do we do to the individual assets?
When there is a reversal,
Yes.
then you take it to the value. You see, at this point in time, once you review the carrying amount and the recoverable amount, okay, the recoverable amount is going to be above the carrying amount, not so?
Yes.
Are you getting it? So you can't take it to, remember we said you take the lower. Do you remember this statement here? Do you take this statement?
Yes.
Remember this statement here? Let me show you. I put it on.
Law of the truth.
Yes?
Law of the truth. The law of the recoverable one and the other one.
This one here. So at that point, it means that the carrying amount is lower of the carrying amount is lower of the recoverable amount, not so? So you maintain it at its carrying amount. That is a very good question. Members, are you remembering this? That is what Michael was asking. At the time of reversal, you take the law of carrying amount and recoverable amount. So you are going to maintain the carrying amount of the asset, and then you reverse the impairment loss. Is that okay with everyone? And Michael, is it fine now?
Yeah, it's okay.
All right, that's a good question. Thank you. I'm sure it has helped many. So this is the question. Can we try out and then put our submissions in the chat box? But please don't take so much time, because I want us to go through IS 20, IS 23, IFRS 5 today itself. If we can't, it's okay, but at least we can try. Yes, anyone? I've also seen for Florence. Florence, finish up your attempt. I want us to, even while you are typing here, try to employ the technique of SSC. That will make we have Joseph, Florence, Michael. Florence says we have to review impairment as per. Okay, this is done. Raymond, any attempt made?
Yes, I'm trying to send it.
Okay, let us get your attempt, then we can discuss and see how we can earn the marks. Yes, we are waiting for you, Raymond. We are waiting for your suggestion so that we can go through the question and see how best would have answered.
I have sent it.
Yes, I'm trying to get it. Let me pick it. So we have here, Michael, then we have Raymond. So these are all your suggestions. Raymond says, as per conceptual framework, Spartacus should be recognized as an asset in the financial statements of Freeport. The reduction in the performance of Spartacus is a sign of internal indicators per I-36. There is an impairment review should be made. We are all forgetting here. Red flag. We shall see. To me, Spartacus is a single player where his performance are appraised separately. However, the whole team is a CGU, and their joint performance is considered. Only the service fee should be lost by his agent. That's my this is okay. This is very okay. But Michael, we don't use to me. We shall see how to attempt the questions. Can you please confirm if my screen is visible and my audio is clear?
Increase the font size a little bit.
That okay now?
Now, you increase the font size a bit. It is not clear.
Okay. Let me increase it to something that we can all see. Let me take it to 15. Is that okay now? Is that okay now?
Yes, it's fine.
Okay. So Michael got something right. A single player, therefore, should be considered as a CGU. That is right. Raymond said we should assess for impairment. This is a single player, so we cannot. You have to talk about CGU. Friend says, since Spartacus had demonstrated poor performance during the year, we have to review impairment as per I-36. That is partly in the answer. Joseph, we would capitalize all the costs to bring the part to Freeport as an intangible asset. This is amazing. This is okay. Good observation. And amortize them over the 5 years. Perfect. But Joseph, since there are figures in this question, you must give those figures. Out of those figures that you see, how much should be capitalized? Then tell us we should capitalize this much. Then after getting that amount, you amortize by dividing by 5, so that you get how much should be charged as amortization expense. Then here you say, due to his poor performance shown during the year, would need to assess for impairment. We said this is red flag. You should talk about a CGU, since a single player cannot be treated as an independent revenue generating point. Let us go now to my interpretation of the question. We have over five standards. Okay, let me say 3 standards in this question. Let me show you. On 1st February, is someone putting up their hand?
Yes, I was trying to inquire. So now in all that scenario, like in the exam, how do we know that this is the standard we're supposed to apply for this case? Because now I see that, I feel like we should talk about the conceptual framework, Michael being an asset. Then I think so. My main question is like, how do you know that this is the standard you should use for this particular question?
Perfect. Do not talk about the conceptual framework unless you fail to identify the standard. You get it? But for this question, the standards that should be applied are clear. So we give what you should know is we give priority to the standard. Even where you think there is contradiction between the standard and the conceptual framework, the standard wins. The question of how do I know which standard to write? When you read and get 10 standards, write about all of them. Is that clear?
Yes.
Whichever standard you identify in the scenario, state, apply, and conclude about it. Hope I've answered you very well. Okay, let us start. On 1st February 2008, a famous football striker, Spartacus, transferred permanently from Rutland AFC to Freeport United under a 5-year contract. This is timing, important. And since they're talking about a contract, okay, we defined something under IS-38. How is an asset identifiable? Since there is now, this is what? Contractual. So that is a hint. Freeport United paid Rutland United a 32 million transfer fee for Spartacus registration certificate. You see, these guys bought a registration certificate and they paid 32 million. So this is the cost price. Okay, now this becomes an intangible asset.
I'm not getting your audio properly.
You can't hear me?
I'm
Yeah.
getting you properly. You're not audible.
Can you hear me, guys? Can you hear me, please?
You are breaking. Now we can hear.
Okay, I think it's my
You're
network.
breaking.
Okay, can you now hear me?
It's breaking a bit.
I'm getting.
Michael, can you hear me?
Yes, I'm getting.
I can also hear you.
Okay, let us proceed. Are you seeing how I'm trying to analyze the case scenario? Freeport United paid Rutland United a 32 million transfer fee, cost price, but buying what? Registration certificate. Okay? And also paid a 25 million signing on fee to Spartacus himself and a 3 million fee to Spartacus agent. Now this is very tricky. This amount here, and also paid a 25 million signing on fee to Spartacus himself. This amount here, it is an employee benefit. Okay? This is an employee benefit because it is given to the what? To the player. So it cannot form part of the initial value of the asset. And a 3 million fee to Spartacus agent. You see, for them to be able to have Spartacus, they had to pay some money to his agent. So for Spartacus to be readily available for use, they had to pay the agent. So this is a directly attributable cost, which should be capitalized if you can remember very well your concepts. That should be capitalized. So you can say bracket part of the cost. part of the cost. Freeport has an enforceable right to retain Spartacus's services for the entire term of the contract. Now this one here, they are showing you that they control Spartacus. So this one is showing us control over Spartacus, control over Spartacus. And now these are all indicators of, they are giving you the concepts under IAS 38. Spartacus started playing for Freeport's first team immediately. Here they are telling you these guys were enjoying economic benefits. Okay? Freeport enjoyed economic benefits immediately. So up to that point, they are trying to confirm all the conditions of IAS 38. How many of us saw that? I know some of you saw. So this was employee benefit. I didn't put. This was employee benefit, which is IAS 19. Those who have done the standards already. This one here, they're trying to show you IAS 38. So far we've seen how many standards? 2. IAS 38 and IAS 19. But in my discussions, I'll only look at IAS 38 and let us see down here. During 2x8, Freeport United played badly and dropped to the bottom of their league. At 31st December 2x8, it was identified that Spartacus in particular had demonstrated poor match performance since transfer and scored only 1 goal for Rutland in 36 league matches. Okay? Okay. Despite this, Spartacus continues to train and play regularly with his team. So what we should know is, what are the indicators of impairment? Okay. This guy has poor performance, but have they dropped him? Can someone answer? Has he been dropped?
No.
What does it
No,
mean?
they haven't.
They haven't dropped him. So since they have not dropped him, this guy is not impaired, because he continues to give them value. Okay, so we can say not an indicator, not an indicator of impairment. But I think someone talked about, 1 second, someone talked about, where is it? During this, Freeport played badly and dropped to the bottom of the league. This can be an indicator, right? Indicator of impairment of a CGU. Yes, please, let me get to you. Someone is popping up and all. Yes, Raymond.
According to the scenario, they say that the one you have highlighted in the lower part is, despite this, Spartacus continues to train and play regularly with the first team. That means they went back to their means they went back to their team. So I feel like they went back to their team. You see, have you seen that thing, the first team? What were they trying to insinuate?
See, these guys dropped to the bottom, okay? But Spartacus has always been with the first team, so he wasn't dropped. Are you getting
Oh, I now get it. Yes, I get it.
You have to really understand the scenario, eh? They dropped to the bottom of the league, but he maintained on the first team, meaning that he still had the potential to perform. He wasn't impaired. Do we get it? So this is IAS.
I get it. Because for me, I thought when I saw first team, I thought it was the other team where he previously came from. That's what I thought. Yeah.
No. It is first team. Nti yasigala akyazanya. Okay. So is this analysis fine and we start now drafting our answer? Or I let you guys to draft it? I'm waiting for suggestions. Michael,
Yes.
should I allow you to draft the answer using my hints?
No, I may try.
I think, yeah, it is better for you guys to... Joseph says that I should draft the answer. Joseph, even if I draft, things will become very easy, but when you try, they'll be very hard. So, I'm giving you this as an assignment. You only pick out answers for IS 38 and IS 36. Apply state. Okay, you follow state, apply, then conclude. And you submit those answers. That is like your mock tomorrow. Is that okay? I'm going to upload it in the classroom with even the hints. So that for you, what you do, you just state something from the standard, apply from the case scenario, then conclude. You only deal with IS 38 and IS 36. Whatever I have put in green under IS 38 and 36 should appear in your answer. And those standards should have at least something from them. You should define what an intangible asset is. You should talk about what are the criteria for an intangible asset to be recognized. Having control, if there are rights, and all that. When it comes to IS 36, you talk about definition of impairment, asset, indicators, though you don't have to mention all of them. You say that as per IS 36, an asset should be reviewed for impairment if there are indicators. As simple as that. Then you go to application. Then you conclude. Is that fine with everyone?
Yes, sir.
I had planned to cover the remaining two standards and non-current assets, but let me check as per our schedule which time can we use to save, which time can we use to cover those two that are up there. In fact, the three. IS 20 is brief, IS 23 is brief, even IFRS 15 is also very brief. So let me check and see. I think under group 2, I can cover. Those are all heavy standards and very important. Under group 3, those are also heavy. Okay, we shall see when we can cover those three standards, IS 20, 23 and IFRS 5. What I'm sure of, it will not take time. And what we've covered today is very important in your syllabus. So can I wish you a good night?
Thank you.
Good night. Please, I'm going to share this question. You draft the answer and then you email me. Those who can do it before tomorrow evening, I'll be able to mark and give you feedback tomorrow because I'm home. Have a good evening.